There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Auvorians, to the Saturday, hopefully technical-free software strategy session. My name is Steve Vetterl, Tech Fix Extraordinaire. No, actually, I stink. I was having total feedback coming through my microphone, which probably had something to do with too many Bluetooths on. So, let's jump to the most important thing of the day. And what is that? His name is Jerome Powell. He is the chairman of the Federal Reserve. He spoke yesterday. Markets crashed. So that's our theme of the weekend. When Powell speaks, markets crash. Why? I linked to this speech, which the Federal Reserve posts. This is the Jackson Hole prom, as I call it, where about 100 central bankers from around the world, economists and think tank brains get together to plot how they're going to wreck the common man's life over the next 6 months. So, in all fairness, I thought this was really nice piece. One of our devout followers of the Market Watch broadcast by yours truly pointed out to me. I thought this was great. It's an exceptionally salient paragraph to what's going on. Restoring price stability will take some time and requires using our tools to forcefully bring demand and supply into better balance. Notice the term forcefully. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will be very likely some softening of labor market conditions, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation. They will also bring down some pain to households and businesses. There are unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. What do we take from this? We basically take that Powell has all but told us there is pain to follow. Question is, which nobody has the answer to, including me, I get some stuff right, I get some stuff wrong, right? But we just don't know how far and wide the, let's just call it, pandemic in stock prices is going to continue. So, start off with FinViz, daily charts, everything. This is an entire dashboard. If you're not familiar with this, it is one of the best on the internet, period. Finviz.com. Click on futures, all daily charts. Start off at the top with equities. You know, don't focus on the Dow, obviously. Focus on the S&P 500, but you can see stair step up, elevator down, right? Big time hits in all markets. This is 100% and completely correlated to everything that Powell said yesterday in his speech. Markets popped slightly, which is a reaction jerk, and then the absolute rug pull came into the marketplace, right? So what does this have to do, Steve? You talk a lot about equities in these broadcasts. It's supposed to be about global macro strategy and Forex, right? Well, most of the pin action off of what's going on in all different trading, including prices of real estate, has really just been a pin action off of what's going on in the credit and equity markets. So I think it's always wise to start off by looking to see where all of the money trades in most hedge funds on this planet, and it's across the stocks that comprise these two, and actually even to a larger degree, are these indexes. Or you can look at it, this is the Wilshire 5000, is a more broad-based encompassing area. So Interesting to see the VIX. We haven't talked too much about this, but the VIX did pop. Um, Continued drop in energy. Surprisingly enough, this was not any safe haven run to gold or any of the metals for that matter. They continue to sell off from some spikes. This is more of the baby in the bathwater type thing. I'm most interested in what's going on here, okay, and how that correlates to the forex markets. So, for those of you new, credit means bonds. This is next to forex, one of the larger markets in the world as far as traded asset classes. The 10-year note is essentially what they base mortgage rates off, at least in this country, and typically the midterm, or I should say the mid-size type notes for most countries in terms of duration and maturity is what they base mortgage rates off of, and a lot of other rates, right? So the Fed basically signaled with the communications coming out of Jackson Hole over the last few days that, hey, we've got to fix this first. We've got to tame inflation. We're not as concerned about wrecking global marketplaces to do that. Okay. So remember, each of these marketplaces, regardless of whether it's commodities, equities, real estate, credit markets, forex, they all have an interwoven relationship that changes depending upon the period of time. So I always try and talk about markets in terms of globalness instead of just drilling all the way down into a particular currency pair, right? Um, Believe me, it will benefit you, even though you may disagree with the technique. It will benefit you in understanding things from a large framework and then being able to drill down inside it, right? Because then ultimately the key really is the most prepared, the ones that can envision where markets in a particular trade may go, are the ones that always understand kind of why it moved to that point, because they had a theory or some sort of thesis they were building as to why it could move into that area, right? So then when it does, it's no surprise you react accordingly. That is the ultimate in risk management preparation as far as trading, right? Everything I can teach you will sort of lead you down the path of self-discovery, but along that way, there's going to be some bumps in the road, right? So as I've talked about in goal setting and becoming a good trader, regardless of what you trade, I don't care if you're trading artwork at Sotheby's or Christie's, right? You're buying and selling classic cars, you're trading the markets, you're buying and flipping real estate. It all comprises the same amount of risk management. What is that? It's understand your marketplace, understand how it auctions, understand price, understand the aggregate of change in price, where all the players are playing, so to speak, right? Hence market profile. Just looking at aggregates of how these markets work, then drilling all the way down into technical analysis of charts and understanding price action. It's what I spent a chunk of the last 2 decades working on. So we take a look at the 10-year, we can see, and a lot of times I'll start out on a weekly so we can sort of see the grand scheme of things. It's like, well, we're in, you always hear these people on TV, well, we're in a new territory. It's different this time, right? It's never different. It just feels different. But the key to this is that we've been here before, right? When was this period of time? It was the summer of 18. Mortgage rates were a little higher, obviously, right? Remember, as the price of a bond goes up, the yield goes down. It's a complete seesaw or inverse effect, right? So as prices have dropped a bunch, remember this was the cheapest mortgage rates historically, right in here, right? Prices were very high. So as price is high, yield is low, interest rates are low. And this was the best time to secure a mortgage, probably in the next 30 years. Not sure we'll see this again, unless there's an absolute meltdown in every other asset class with the exception of credit. I just don't see this happening, right? But as the financial advisor, let your heart not be troubled in this. Even though you may not be getting a good grade on your mortgage, if you were to go to a 15-year mortgage, or just throw that 13th and 14th payment at a 12-month mortgage, you pay the house off 10 years faster. The faster you pay the house off, the less you care about your interest rate. Yes, it does affect your payment each month and it's higher, but in the end, you own the house faster, right? Instead of paying 3 times the cost of the house to buy the damn thing over 30 years. So, just as a side note on that, what else can we glean from this chart? I mean, it looks like we're going back down, you know? Why does credit or why do bond prices fall when interest rates are rising? Well, it's simple supply and demand. If you recall, about 7 or 8 weeks ago, I used the example of a bunch of children sitting in a circle holding apples, right? In this particular case, these children want the new apples coming out, so they're all putting all their apples for sale in the center of the circle. What does that do to price, right? If there is increased supply of apples for sale, what happens to the price? Typically, it goes down, right? Normal supply and demand. All right, everybody's selling bonds because they want the newer bonds coming out because they pay higher interest rates, right? So you can look at this from the perspective of CD rates at the banks are higher, right? Fixed indexed annuity rates are higher. I mean, there's all different types of, multi-year guarantee rates are basically just higher. So it's the first time in a long time that money market rates at your local bank or CDs or any types of sort of fixed interest rate is much higher than it has been in the past 12 years, right? So, sort of the understanding there. Go back to all. Now, I haven't really focused much on currencies because, I mean, there's really not much to talk about. Dollar's going up, everything else is in the toilet, right? I mean, it's that simple. It doesn't need to be any more complex than that. And it doesn't necessarily help. Well, hey, Steve, that doesn't help me as far as trading off a 5 or 15-minute chart. That's true, but at least you're understanding why it's up here if you've been listening to my casts over the last few months. You are in complete understanding of these moves. You may not know why they moved to that, right? You have an idea, hopefully, but you're not. I always use the example of just running into forget it. I'm not going to get into more examples. That one requires explanation, but just understand kind of broadly from a macro perspective why things are going on right now. Let's go back. Because I said, let's look at dailies, this weeklies. I said we probably are going to go back up and test the highs of this. So that would certainly argue being long anything dollar, at least in the last few days, and short everything else, typically, at least it's denominated in dollars as far as the major, or I should say paired with the dollar, right? But I don't really know where we're going to go from here. I mean, the path of least resistance is higher, okay? So if that in fact is the case, you have to take charts out to like a long time ago that the dollar was actually this high. I mean, like real long. We're talking 20 years since the dollar has been this high. And as I've said a zillion times, I will say a zillion more. This is the lesser of all evils because beyond normal understanding of economics, for the life of me, I can't see why this is the currency of reserve with $30 trillion in debt. But this 10, let's actually go look at this in TradingView instead. Let's move to a monthly and then reset. Let's do full screen so we can see the whole shebang. So follow the crosshairs here, September of 02. About the last time we were here, and we're almost perfectly at that point. The high point of this was a really good slingshot, by the way. If you aren't looking at this, from back in 02 was actually an excellent slingshot. We came back. I mean, this is the resistance right here, and we're 70 pips from this zone. So I would expect, at least in dollar land, us to go up and tag that. When, how long, for what period of time, I don't know. That's what I would see as far as the upside. So you can take all of those targets on all the paired majors and underneath this, like the euro, and set it for the bottom of that, right? That being said, for now, I'd probably let this play out on Monday and Tuesday, frankly. But once the dust settles and everything's got some direction, which more likely is going to be down in the equity markets, right? I'm a crapshoot as to where bonds go from here. I would assume the least of resistant path is down, right? So then obviously the least resistant path is down on the euro, right down to this whole zone right here. So that's basically, say somewhere in this 0.9871. But hey, look at it this way. If you're a traveler from the US to Europe, you don't have to do any currency conversions because the dollar gets you a dollar, right? Hey, how much for this? For you, $1. Right, let's take a look at the pound. Okay, so 1 month chart as well. God, we got to go all the way back. I mean, the answer is, oof, we got to go all the way back. Am I reading this right? I mean, this almost doesn't even matter. Last time the British pound was this low was 1985. I mean, let's just reflect on that craziness for a minute, right? Hell, this may even get to par, and then you can actually buy goods and services with them U.S. dollars for a buck in the UK. I may get a far ways to go on that. Actually, the lowest this has ever been is 1.056. Is that right? Yeah, this is the lowest it's ever been outside of 1985. So if we're just looking in recent times, we are at the lowest we've been. Actually, shouldn't say that. I'm taking maybe my blindness here. This looks like a reactionary low. I don't know that I'd put much stock into something to just see how high the volume was here. So, by the way, if this was a solid auctioning day, it didn't look like it was to me. This is a great example of whenever you have these flash reactions, especially if this took place inside the U.S. futures markets like the ES, which is the E-mini 500. Anytime you see these flash downs, especially if they're accompanied by high vol, will almost always come back and visit that point. Why? Because this was an incomplete auction down here, and there's a bunch of missing notches from perspective of filling the volume. So markets typically, don't tell me why, but typically will gravitate back down towards those reactionary lows to fill the void. Almost as magnetized, if you will. So this is 1.14. If you're trading this, I would expect us to get to that area. All right. I've ripped through these on Tuesday, so at least you got a chance to take a look at them. Nothing really going on here. I mean, we're looking at monthly charts, guys. So the ascent in dollar yen has back on deck. Actually, I'm going to drop this out to a daily. 139.16. Bananas. That's what you got to say. Actually, you know what? Let's take a look before I get in deep here. I do want you guys to note this. This German CPI. Pay attention to this one on Tuesday. All day just means it's to be released at any time. Do note next week is non-farm payrolls. I'm not sure how much weight this is going to carry because one, it's on a holiday Friday, right? Less volume. The last hurrah, if you will, if you're a U.S. resident living on the East Coast. This is the last hurrah weekend before the deep freeze ensues up north, right? Where a huge chunk of the population in this country lives. So they want a vacation and get it over with and then get back to school and work. So as we move into the first couple of weeks of September, I always call that the back in the helm by the big guys, right? So they've been on vacation out in the Hamptons floating around in their yachts, the ones that control most of this money. This is via large sovereign mutual funds and most of all the hedge funds that control this stuff. They're out floating around on their yachts right now. So they'll be back in action. I think volumes will pick up dramatically, as they always do. Then you can put a lot more stock into these movements because there is participation by all players in the market. All right. So that is next week's calendar. Chairman Powell. Notice I didn't dive into the weeds as many of the talking heads on television do. I just take the bullet points out of the presentation, look to see what the markets did, and not that difficult to put together your plan for next week, which is short the ribs or buy the dips if it's US dollar. Let's see what's going on in wacky crypto land. So this is Bitcoin. And for what it's worth, in terms of risk on, risk off asset class comparisons, a lot of folks would say, well, crypto is completely uncorrelated to everything else, right? It moves by itself. I say, you know what? Phooey to that. Why? Because it's moving just like the equity markets. I mean, the correlations are crazy connected at this point. So why wouldn't you want to pay attention to what's going on in other markets so that you can get your cue as to what potentially could go in here, right? If it's risk off across the planet, it's risk off in almost everything, right? And if it's wicked risk off, everything's being thrown out because we are very leveraged in a lot of areas, certainly in the equity markets. So risk off means just that. Sell almost everything that is risk off. Spend enough months doing risk off, you go into a recession, possibly a depression, and then it spills over to the real estate markets. We're already seeing that in total spades, depending on the area, right? I mean, homes on the market for sale. I'll tell you, if the equity markets go back down to the low, there's just going to be an absolute gluttony of stuff for sale. And these are all the idiots that I call the late to gamers, right? The ones that leverage their life, don't be this person, to buy 6 houses to flip, and now they're left holding 6 houses, and the bank's calling in the notes, right? This is exactly what happened in 08. It just wiped a lot of people out, especially the real estate flipper market. So, don't let that leverage come and get you when the tax man or the note man starts calling their stuff back in, because they can do that, right? A lot of people didn't realize that a bank can call in a note on a property. They absolutely can call the note in. If you don't have the money and you can't sell a property to cover it, guess what happens? They start the foreclosure process, right? So just be smart about that. As you can see, I've had experience in a host of asset class markets. I've never got caught flat-footed, never had too much margin. Call me too conservative. I'm totally okay with that. I'd rather not lose large amounts of money, right? There's a joke from some of the top traders in the world. They have two rules, right? Rule number one, don't lose large amounts of money. Rule number two, don't be stupid enough to forget about rule number one, right? In any case, let's take a closer look at some coinage here. And it seems to me, if the tea leaves are shaking out in my favor, that a return back to this mid 18 area per coin looks like what's going to happen. Look at spot gold. Again, these are daily charts. Surprising thing to me, really, honestly, and hey, that's just solidifying my thesis, which is there's big players just waiting to keep dumping this every time the price pops anything significant, right? But usually, if this group, let's just say if other time frame players did not exist, gold should be much higher in this current environment. So I always say trade the markets you have in front of you, not the markets you think it's going to be. And there's GBP CAD. I wanted to show this daily chart again because we're at new lows. Shouldn't be surprised. Pound's way down. If this hadn't moved, but the pound was making new lows in the dollar, what's that tell you about this pair? Look out. It's about to follow, right? Perfect correlation because both pairs comparisons hold the pound as the first and primary currency. Making new lows here. Bet your bottom dollar we making new lows there, and vice versa. Although, quite frankly, I think this one leads around all the others in relation. It's a big reason why I always start my analysis with DXY and then move into Euro GBP. If you just analyze this, maybe a couple of CAD pairs, and outside of that, you probably have about 75, 85% of your analysis finished in the currency markets because everything's going to take some sort of cue off that. And I'm talking about majors, not the crazy crosses or any of the minors. What else? Energy prices way up in Europe. No surprise. It's that's continuing to get global coverage. That is just not good. There's a fair amount of heads are going to roll at energy commissions in Europe because of this. And it's for a lot of the rotten structure they've put in place is because of this, that's causing this. And, obviously you could say, well, it's not their fault. It was the geo events. And, well, but the point of a stress test, right, is to look at any system. Like, let's just take the stress test of the banks and the banking system in the U.S., right? They've been stress tested the bejesus after the financial crisis of, 07, 08, 09, right? They were tested. Some of them broke. A bunch of them, the government had to bail out. But now they're in much better shape, arguably, than they were at the bottom of the financial crisis. I still think the leverage is the issue right now in these markets. But, it's almost like they never even stress tested any of these European, not only the energy grids, but the plan they have in place to run it, the commodity backups they needed to run it, stuff like that. I don't know. It just seems like a pretty epic fail from a planning perspective. I could be wrong. That's just my view of it on the surface. But we have a lot of European folks on board with, not only as traders but folks that live in Europe that are subscribers of a lot of Auvoria, and a lot of them trade Forex. So, our our hearts go out to you in this energy thing. And, honestly, if you want to have a voice, get out and vote, get out and organize. If you're living in a democracy, you have the ability to organize, vote, and rise up against the current regime. Maybe that should be my theme. My theme is always risk management, so it never changes. And so what else do I want to talk about here? I think that pretty much covers everything. So I'll probably next week. Next week is a holiday week in the U.S. So, for lack of a better understanding, typically volumes are lower. It usually is a period of time where if volumes are low, doesn't mean crazy movements can't happen, right? They absolutely can because of the low volumes. So my advice next week, for that matter, the next 2 weeks, is be aware of that. I typically do not go in heavy trading until we get some sort of direction post Jackson Hole, right? I'll usually be one of the few times listen to the opinions of my favorite 10 talking heads. Most of this group, in my opinion, comprises some of the smartest traders and portfolio managers out there. Jeffrey Gunlock is one of them. I want to shake out and see what these guys are saying about this. Everybody's sort of stewing the pot, and they'll come out with their comments next week. Don't think it's going to be much different than what Chairman Powell said, because I think he's been a heck of a lot more transparent than any of the days of Ben Bernanke or Alan Greenspan, where the phrase Fed speak was coined. And especially in Alan Greenspan's case, it was just, you never understood what the hell the guy was talking about, right? And that things like irrational exuberance, and then the market crashed, and then a bunch of hedge funds blew up, and there was more risk in the market, and there was that leverage thing again that came into play, right? um, it is for everybody's disagreement that the Fed's doing the right thing. For at least we can all agree on the fact that the communication from the Fed is pretty clear what they're going to do, right? And that's why markets sold off a lot on Friday. So, everybody have a great weekend. Trade safe and be safe. How's that? And may the trades be with you. Steve Vetterl off the mic.